short-term outlook on the rupee is neutral, and we expect the rupee to hover in the range between 75.00 to 76.50 till the end of June 2020. The speculative activities in the local forex market have subdued, and the domestic currency strength is guided by the demand and supply of dollars in the market. The trade volumes were low, which helped the rupee to maintain a stable environment. The overall positive trend in the global stock market has translated into the domestic currency posting marginal gains against the dollar. The plunge in crude oil prices, combined with a steep fall in export earnings and significantly lower imports, could result in a current account surplus at the end of the current financial year. In the circumstances, the probability of a rating downgrade is very low in the short term. The huge forex reserves of USD 487 billion would help the central bank to reduce the currency volatility in the market, besides protecting the currency from any sharp depreciation arising out of negative GDP growth, rise in unemployment, fall in consumption, drop in business confidence, and other bleak economic data. Due to the damaging economic impact of lockdown in the country, the real GDP growth could fall by 5% in the current financial year, which would be deeper than any recession India has ever experienced. In order to mitigate the difficulties being faced by the importers for settlement of import bills on the due date, RBI has now permitted to extend the time period for completion of remittances against normal imports into India for 6 months to 12 months from the date of shipment for such shipments made on or before 31/7/2020. This measure will provide greater flexibility to importers in managing their operating cycles on a COVID-19 environment. Due to repo rate cut by RBI by 40 BPs from 4.40% to 4%, the forward dollar premia for 3-month and 6-month maturities has fallen to 3.60% per annum, which would enable the importers to reduce the effective interest cost on the import bill extensions made by them to less than 6.75% per annum, all inclusive in rupee terms, as compared with the rupee funding cost of about 8.5 to 9% per annum. The cost savings which could benefit the importer client will be at least 2% per annum due to extension of import bills as per the revised guidelines from Reserve Bank of India. We strongly advise the importers and exporters to strictly adhere to the internal benchmark rate mechanism in hedging their exposures and recommend a spot target level of 75.50 for hedging the import payables up to 3-month maturities and hedge the export receivables in various tranches beginning from the spot level of 76.00 up to the next 3-month projected receivables.